Today, we would like to share how you can incorporate economic indicators into your investment framework with StockPenguins.com's new economic indicators. So, our newly launched feature will allow you to choose different economic indicators that we have singled out to be of more importance through various aspects. So, your GDP growth, your inflation rate, your employment rate, your interest rates, your consumer sentiments, federal fund rate, and treasury rates. And you can even overlay different stock charts like I did with Apple over here onto the chart, right? And even your market indices. So we have done and singled out this for you because I think as a retail investor, from a retail investor's perspective, there is a lot of different economic indicators out there that may or may not move the needle as much. So based on the 80-20 rule, right, we have singled out the economic indicators that we feel will portray most of the information you need from the markets, right, in your investment frameworks. So besides just showing the charts and overlaying it and seeing some form of pattern harmonization, right, I think it's very important to understand from a economic perspective of why some of these indicators are important, right? So usually when you do stock investing, right, as a normal retail investor, there are two verticals that you can approach it, right? Number one is the bottom-up approach, which is your typical fundamental analysis, right? Like you can use StockPenguins.com's different, company financials where you can deep dive into the company's performance by itself, right? Its financials, key ratios, its what management is saying through its earning calls, right? Analyst ratings, how people are thinking about the stock, right? For as an approach. So as mentioned, your financial statement trends, your quality of products and services, right? Your individual companies' narratives versus the industries, your management, insiders, and ownership. So that is one approach that you can, build up your portfolio, which is through bottom-up stock picking, right? Another approach that people would tend to use is the top-down approach, which overarches the macro analysis, right? So I think the main reason why someone would do a top-down approach into investing is to understand general liquidity flows, where money is flowing to, right? So part of this is through understanding whether we are on a risk-on or a risk-off environment, and how, depending on what environment we are in, how different market participants are rebalancing their assets, right? And I think all of this ultimately leads to most market participants get their sense of direction from what the Fed is doing, and the Fed gets their direction from the macro analysis. So you can see it's like a flywheel, right? And I think it's also extremely important today to incorporate top-down macro approach into your investing framework, because the modern market today takes a lot of cues from the central banks because of how they've been just pumping a lot of liquidity into the markets ever since the 2008 financial crisis, right? Central banks have played an even more crucial role in today's investing environment. So I think as a retail investor, there is this quadrant that we should understand, right? Which is, from a top-down perspective, we need to know where is the most favorable environment to invest in stocks. So this is based on liquidity, which is based on this quadrant, right? On the y-axis, we have the Fed's balance sheet, right? Whether they are undergoing a quantitative tightening or a quantitative easing kind of situation, right? So if they are tightening, right, you'll see their balance sheet start to shrink, and if they are easing, their balance sheet will start to go up, right? And on the x-axis, you have interest rates. So interest rates is something that the Fed can set. So if it's lower or higher, so the most favorable for investors to invest in is in the most liquid environment, which is where interest rates are low and when balance sheet is starting to ease and is high. So this is the best environment for us to invest in. And for retailers who typically have access to stock, the worst time to invest in is when things are the least liquid, right? Because this is where you get the least flows, and maybe you get more returns in your treasury use, and it's even safer, right? But I think that from a top-down perspective, it's very important to understand that data points are all correlated, right? So you can't just look at, for example, your inflation rate by itself or your unemployment rate by itself. All of these economic indicators are all correlated and each play off each other, right? So you get a sense like that. So you can't just look at one data point as the most decisive factor. Number two is not all data are important. There are weightages to these different data prints, right? And to understand how important one data print is to another, you need to understand the current market cycle, the narrative, and the structure. So, for example, in today's market, we are entering a quantitative easing environment when interest rates are starting to be slashed by the Fed, right? So the current Fed chair Powell is kind of a very data reliant guy, and he's, I think, to me, naturally hawkish kind of guy. He's very safe in his approach, so he needs a lot of data confirmation to continue his rate cut path. So for this, right, I think it's very important to look at the job numbers and the inflation rate. So yeah, because the Fed is looking to balance inflation risk against weakness in the short-term job market right now, and they're embarking on their interest rate cuts. So these are some of the things that you have to look at, right? So the Fed is particularly sensitive to job numbers right now, and balancing on inflation risk. So I don't think they're paying that much attention to like your standard GDP growth for now, because yeah, all this is, you can get these cues from reading their monetary statements, their announcements, the meeting minutes, and also whenever Powell speaks, he will tend to share his thoughts and sentiments and what he's looking at. So these are some of the things that you have to, as an investor, it's prudent for you to go and understand what he's thinking of, because he decides where liquidity flows in the market right now, right? And as mentioned, each type of data could have different types of prints, which is why we have already selected over here a preset amount of indicators, so it doesn't confuse the average retailer. Because if you look at Forex Factory, right, so let's just take, for example, next week's data. If I don't filter out the different importance, right, you get a lot of different data points that may or may not move the market. So we at StockPenguins already like pre-selected for you, so it makes life easier in a sense, right? Number 4, a single data point does not determine the Fed's action. So as mentioned earlier, right, not just the different amount of data, but the different amount of data prints. So for example, let's say the most recent inflation print could be a certain number, but that by itself may be just a one-off case. There needs to be a trend that's showing for it to be like something of significance and importance, right? And that especially since Powell is someone that really looks into trends and he wants more data to, justify his action plan, right? So let's talk about the different types of economic data. So GDP, which we have already have it here, the GDP, real GDP, industrial production as part of GDP and growth. So GDP is the general output of the economy. By itself, it may not be that important because it is only released every quarter. I think what's important is the data leading up to this computation, right? So contributory data points, which is what the Fed monitors as well. So you have to do that. So, and also, I think in general, when you are looking at data, economic data, right, the absoluteness of the number itself may not generally mean much, but it is how the actual data performs against the expectations that's important, right? So for example, if we go back to Forex Factory, you always see that there's this forecast here, previous and the actual. So this is blanked out because it hasn't happened yet. So it's very important, like the actual data point, how it performs against the expectations. So did it beat to the upside or did it miss to the downside? So usually when there are extreme beats, right, this shock creates like volatility in the market in the short term, right? And also, to give you a sense of what I mean earlier by like a quantitative easing and quantitative tightening kind of action plan by the Fed, right? So usually expansionary approach, which is easing by the Fed, generally means two things, right? So they reduce interest rates, so they cut interest rates, and quantitative easing, so they may buy up more assets from the market, things like that, to expand their balance sheet. So if you look at a metric that I like to track, it's a Y charts, US total assets held by all Federal Reserve banks. So in a quantitative easing environment, like you see from COVID period, right, the Fed's balance sheet will expand significantly, and not coincidentally, but at the same time, the Fed, the stock market at the same time in 2021 and 2022 had a massive rally. So this is pretty much aligned, right? So yep, this is an expansionary environment. A contractionary is where the Fed will increase their interest rates to sort of cool inflation, right? Because when you increase your interest rates, your cost of capital increases. Your funding all your capex projects by businesses starts to become more expensive. So they may slow down all these kind of plans, may slow down your hiring plans, which helps to cool the economy in a sense, and it also makes borrowing more expensive. So you cannot go and borrow heavily to buy your any expensive things that you've been eyeing, for example. And also, I think when you increase in your interest rates, it makes your risk-free assets a lot more attractive to hold, because you're not bearing it. The amount of risk you're bearing is like basically zero unless the US collapse, but now the return you're getting is higher. So it makes sense for any investors to rebalance their assets and take more of these risk-off assets into their portfolio, right? And they will engage in quantitative tightening. So if we go back to the the US dollar assets held by all Federal Reserve banks here, is when 2023 you see somewhere around 2022 they start to reduce their asset base, right? So this is where you see that the market started to pivot also in 2022 and 2023. There was sort of like a bear market where your risk-on assets like stocks sold off heavily, especially your tech names, right? So yeah, these two environments are very important to understand, because like I mentioned earlier, your economic indicators will determine the Fed's action, which will also determine what kind of expansionary or contractionary approach they would do in their interest rates, on their balance sheet management, and then this will affect how your liquidity flows across your different risk-on and risk-off assets. So knowing this may help you, balance your portfolio cap appropriately, and knowing when to buy heavily or knowing when to be more prudent in your approach in buying stocks, right? And second form of data, so like I mentioned, the contributory data points. Number one is inflation, right? So you get your CPI, which happens on a year-on-year, month-on-month basis. So it's a key economic indicator that measures the average change over time in the prices of a fixed basket of goods and services commonly purchased by resident households, right? So one thing to note that it's a year-on-year, month-on-month versus month-on-month basis. Longer-term data are more concrete and less volatile, right? It makes sense, right? It takes into account like about 12 months of data prints rather than a month-on-month approach. And the Fed's target for inflation over the long term is 2%. So deviations around the 2% mark is common. That is normally acceptable, maybe your plus minus 0.1, 0.2%, right? Core CPI. So it reduces the price of food and energy, which is the most volatile item in computing your average normal CPI. Your PPI is your price paid for manufacturing goods. It's a leading indicator of CPI because for all this business, right, especially at the highest point of the supply chain, all this PPI, all their prices paid for, they may or may not choose to pass down the supply chain, and then this ultimately gets passed down to the end user, which is your CPI print, right? So as you see PPI start to increase heavily, it's a very strong sign that CPI will start to follow suit as well sooner or later. So going back to this Fed 2% target, right? So this is a general long-term target of the Fed. So if inflation shoots way too high above 2%, this is where they will start to increase the interest rate or adopt a contractionary approach to bring inflation back down to 2%, right? So as mentioned here, high inflation, contractionary environment. Neutral inflation, neutral. So the Fed may not do anything and just stay on their current status quo. Low inflation, expansionary environment. You'll cut interest rates, and then expand their balance sheet to try to boost the economy again, right? As your interest rate get cuts, your cost of borrowing gets lowered, and this is where some businesses may start to borrow more to fund their projects. Consumers may make use of the low interest rate to fund their high ticket purchases, for example, and then this effects will spill over to the general economy. Jobs. So unemployment rate. How many are unemployed who are seeking for jobs versus the total actual workforce, right? So the low number equals a stronger economy, and there's more need to hire people to fulfill demands by matching supply. So unemployment rate, there isn't like a exact indication of what the Fed looks like to be strong or weak employment, right? But generally, if the unemployment rate is more than 5.5%, it's a weak job market. 4 to 5.5% is roughly okay. Less than 4% indicates a strong economy, right? Number two, your initial jobless claims. How many people are filing for unemployment insurance for the first time in the past week? So this is a leading indicator of unemployment rate, because if you look at the time frame, this is on a weekly basis, right? But your unemployment rate is like a like a monthly kind of rate. So if this starts to shoot up, you may indicate that unemployment rate may have some negative impact, right? C, non-farm payrolls. It measures the number of jobs added or lost in the non-agricultural sector of the American economy, excluding jobs in farming, private households, and non-profit organizations, right? So all of these are like your leading indicators, your unemployment rate by itself. So like I mentioned, the Fed will balance the unemployment rate against the inflation rate, right? So if there's a weak job market, the Fed may adopt an expansionary approach to cut interest rates to boost the economy. If it's a normal job market, they may remain neutral and do nothing. Strong job market, this is where they might look to raise interest rates to cool things down, because the strong job market generally means that businesses are all doing well, people are doing well, and they may start to spend on things, and then this is where your inflation may start to feel some upward pressure, right? So economic activities related, your consumer confidence is a leading indicator to get a sense of unemployment and inflation in the future, right? So there'll be a monthly survey conducted on households for sentiments on their income, business conditions, and employment status. So 100 to 120 generally see as neutral, above 120 strong, below 100 equal weak. Manufacturing and non-manufacturing PMI, so it's a sense of economic industrial activities in the country, right? So above 50 generally indicates expansion, below 50 contraction. But in this case, I think services are more important because it contributes about 70% of the US economy, and generally they are more sticky, right? The services PMI. So yeah, you can use this economic activities and consumer sentiments to get a sense of your potential inflation rate and unemployment rate, right? So yeah, generally, if the market is expanding, if there's a lot of general economic activity and consumers are like confident, right, it could mean that inflation may start to go up sooner or later, and your unemployment rate may remain low, right? Because businesses need to hire more to meet these strong demands by consumers who are confident in their current situation, right? So the Fed's action plan, weak economy, they may expand, which is to reduce their interest rates, all that to boost the economy. Normal, they may not do anything. Strong economy, to fight off potential inflation, right? They may start to raise your interest rate. So economic activity is important because it has an impact on your inflation and your job numbers, as I mentioned earlier. So overall, I think as a retail investor, you have to understand where we are, what kind of environment we are trading at, whether we're in a liquid or not very liquid kind of environment, and because this will affect how much people are balancing, how they are balancing the portfolio, and how much they're moving on to stocks. And what drives stock prices up, which is more demand, right? So, and more demand generally means there's more liquidity flow. So it's very important to understand your economic environment that you're trading in. And if you don't like to see data points like in this kind of format, right, just numbers, you can use StockPenguins.com's economic charting tools to see how economic trends are flowing now. So that's all for today, and let us know what you want to see next. Thank you.